Hi, I'm Steve Spencer, a partner at SMB Capital, a proprietary trading firm in New York City where we trade stocks, options, and futures. In today's video, I'm going to talk about trend lines. I think there's quite a bit of misperception on the value that trend lines can offer to traders. Some people believe they are a great guide to enter trades, while others find them utterly useless. As is true with many ideas, the truth lies somewhere in between. So, if you're interested in finding out more about this topic and how it can help your trading, stick around. Before we get started in today's video, I wanted to remind you we have a 2-hour free workshop where I spend 30 minutes reviewing our proprietary stock selection process. So you can go to tradingworkshop.com or click on the link above to sign up and check out the 2-hour free workshop. Okay, so talking about trend lines. I use trend lines to help me visualize who is in control of a stock for a given time period, buyers or sellers. This helps my decision-making process. I want to generally be long stocks when buyers are in control and short stocks when sellers are in control. Now, I say generally because there are, of course, exceptions to this rule, which we're not going to get into right now. So I want to give you a few rules of thumb with respect to trend lines that you can use for your trading. If a trend is intact, you should look for spots to enter on a pullback on the time frame you are trading or lower. We touched upon this a little bit in last week's video where I talked about using the lower time frame to fade stocks. But it's important to remember that if you're trading a particular time frame, let's say it's a 5-minute chart and a 5-minute trend, once that trend's established, we want to establish or add to positions on those pullbacks on 5 minutes or a lower time frame chart. We don't want to do that on the higher time frame. It's time frame you're trading or lower. Rule of thumb number 2. If a trend breaks, you enter a defensive posture, exiting a position once there is additional price action to confirm a reversal of the trend you are trading. And we're going to do some examples in a second on this. Rule of thumb number 3. If a stock breaks an accelerated trend, this can be used to enter a new position for a move back to the shallower trend or to exit a current position that you already have. So those are our 3 rules of thumb. Now let's take a look at some charts with trend lines. Now we can apply them. So the first one is one that I grabbed from today. AMD, a stock that many people on the desk were trading as it had a strong opening drive and then started to trend for the day. So many people on the desk were long the stock via stocks and options. And what I've done on the chart here is I've circled the first area, highlighted the opening drive. Stocks that have opening drives are good candidates for trending for the day. So even if you weren't watching this before the market opened for a breakout above the long-term technical level of $30, if you had a scanner or a filter where you find things with strong opening drives, this would have come to your attention. Now, after the strong opening drive, we put in a morning high. That's that horizontal blue line. It pulls back from the morning high. That's what we call our first pullback from the morning high, and that's a point that we use as possibly starting a trend. And then it takes out the morning high, and then we have what becomes a trend for the morning and into the midday. And so once we have that trend established after the opening drive, the first pullback takes out the high, we look for spots to buy into the pullback to the trend. And so if we're looking at that first horizontal line, which was resistance at the opening high, the AM high, and then became support later in the day, the first time it pulls back to it, somebody who is looking to buy at a support level into the opening high, they might use that, but somebody who's using the trend line might say, hey, this trend line that's starting to form, it hasn't caught up to that price yet. I want to see if it continues to hold it for another 20 or 30 minutes, and then eventually the trend line moves up to that price, and if that pullback comes into that area, which had been the morning high, and the trend meet, that's a spot, it's a really good spot to put on a position or potentially add to a position. And then we watch that trend continues higher, 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 and eventually, a little bit later in the day, it breaks. Now, this doesn't mean get flat the position. This doesn't mean short the position. What we're doing is we're becoming, as I said, I think it was rule of thumb number 2, develop a defensive posture, meaning it's trending up, it's now broken the trend line, it's holding below the trend line, and I've highlighted 2 spots there. I drew an arrow up and an arrow down. When something's broken a trend line and starts to consolidate, if it breaks down against what the prior trend was, that's a time to lighten up, flatten out your position, and become more mindful of other potential support areas, which in this case was the morning high. Obviously, after it consolidated there, it never broke to the downside. It broke back up and continued to trend on a new trend line intraday, but you get the idea. Let's look at our next example. The next example was something that had a strong drive down on the open and then went right into a very strong downtrend, and had a quick, hard reversal bar where it broke out of that morning opening downtrend, failed, and then started to come back in. So again, we had something with a pretty steep downtrend on the open, breaks that steep trend, fails, comes back in, and then it actually, it holds the morning low, and depending on whether or not that was a significant level, longer term, perhaps people would use that to cover some of their position because it broke the steep trend. But ultimately, once it got above that horizontal blue line I drew, which was kind of the retracement high when it broke the trend in the morning, you'd have to be flat the stock if you were shorted from the open or long it on the reversal. So that's just a nice example on that one. And I think we have one more example to take a look at. And this one is Costco, COST. On the open, we had a nice consolidation, a tight consolidation range. And then another way that we develop trends intraday is we have a range in the morning, and then it breaks one way or the other out of that range, and then we have a trend. And so in this case, range breaks, we have a trend. So many people are going to be long it on the break of that range. And the question is, after it runs up there a few dollars and it breaks the trend, what do you do after it has that tight consolidation? Well, we covered this in an earlier one. In the earlier one, it actually continued up. It didn't break down. In this example, what happens after it breaks the uptrend is it breaks to the downside. We have to get out of our position at that point because this might be the beginning of a large reversal to the downside. Of course, at the time, the right edge of the chart is we don't see what happened later, which was after that hard down, it started to move up in a shallower uptrend. But that doesn't matter. What matters to us is it's moving up, it breaks the uptrend, it starts to move sideways, and then it breaks to the downside, potentially starting a intraday reversal, and we have to use that to hit out. So 3 examples there for you to mull over and potentially learn something from. The bottom line is this. Trends are tools that can assist in your decision-making process. They're similar to other tools that are employed by traders such as time and sales when we're reading the tape, VWAP, and my favorite, support resistance areas. They aren't something to be used definitively to enter or exit a position without additional confirmation.